Finance is a competitive field, and the fastest way for a candidate to get nixed in the interview process is by tripping up over a table stakes technical question. I've had to turn away dozens of applicants that I loved and wanted to be able to work with because of this, and it sucks. That's why by the end of today's video, I'll make sure you understand finance's #1 most common technical question intuitively, such that you're ready to ace your interviews. Beyond that, you're going to learn how to read a company's financial statements, which is an incredibly useful skill for anyone who is interested in business, finance, or investing. Hello friends, if you're new to this channel, my name is Kevin Yang and I've spent years working across Wall Street and Silicon Valley in investment banking, private equity, venture capital, and impact investing after graduating from business school at the University of Michigan as valedictorian of my class. This channel exists to help you land your dream job in business and finance, especially in careers that make a positive difference in the world, for people, for planet, and for profit. So let's dive in. Here's the technical question. How does an increase in $10 of depreciation affect the 3 financial statements? This is an excellent interview question because it tests not only multiple core accounting principles, but more importantly, how the financial statements relate to one another. So here's what we're going to do. I'm going to answer this question first, and then I'll go through and break down each component step by step. Depreciation is an expense that's going to lower our operating and taxable income by $10, meaning we'll pay less in taxes. Assuming a tax rate of 40%, we're going to pay $4 less in taxes, meaning our net income is not going to be down by $10, but rather by $6. Taking net income over to the statement of cash flows and the cash flows from operations as the first line item, net income is down by $6, but we have to add back our non-cash expenses, which includes depreciation of $10. So our cash flow from operations is going to be up by $4. No changes to cash flows from investing or cash flows from financing, so cash is up by $4. Lastly, moving on to the balance sheet, where assets are equal to liabilities plus shareholders' equity. In the assets accounts, cash is going to be up by $4, but our plant, property, and equipment account is going to be down by $10 because of the depreciation. So overall on the asset side, we are down by $6. Now on the liabilities and shareholders' equity side of the equation, there's no changes to liabilities, but in shareholders' equity, our retained earnings account is going to be down by $6 because net income is down by $6. So both sides of the equation are down by $6 and the balance sheet balances. Okay, now let's slow that down and go over each concept. Let's talk about each financial statement first, and then how an increase in depreciation will affect it. Let's start with the income statement. So the income statement is going to tell us how much money we made, right? You have your revenues, your expenses, and your profit. But let's get a little bit more detailed than that. At the very top of the statement, we have revenue. And the first thing we're going to subtract from that is our COGS. COGS stands for cost of goods sold. Now take, for example, a business that is a potato chip manufacturer. COGS are the costs that go directly into making and manufacturing those potato chips. So those direct costs would be the potatoes itself, the oil you use to fry it in, your seasonings, your packaging, the labor that went directly into making those potato chips. Now this brings us down to something called gross profit. And the next big expense chunk that we're going to take out of that is OpEx, or our operating expenditures. And this will bring us down to something called EBIT, E-B-I-T. EBIT stands for earnings before interest and taxes, otherwise known as operating income. Now to keep working our way down to earnings and our net profit, we're going to subtract interest. Interest is the interest payments that you make on your debt. And that is going to bring us down to EBT, which you can imagine is earnings before taxes, or otherwise our taxable income. Then we take out our taxes, and that brings us down to net income, or otherwise our earnings. I think the only category I missed here was explaining OpEx. OpEx as expenditures and costs. This is kind of basically everything else that's not included in COGS. You can sometimes think about it like as your overhead, right? This is going to include your rent. This is going to include salaries for your marketing team, the marketing expenses itself, the commissions that you pay to salespeople. This is your administrative costs like printer paper in the office or going to a trade show and the travel expenses associated with that, right? All that is bucketed into OpEx. Now, where does depreciation fit into the income statement here? The answer is that it comes into OpEx, but before we get there, we're going to have to talk about depreciation. And you can't talk about depreciation without also talking about capital expenditures. So what is depreciation? You can think of depreciation basically as a reduction in the value of an asset. What asset, you might ask? The asset that you're going to purchase through a capital expenditure. So capital expenditures, colloquially referred to as CapEx, because capital expenditures is a mouthful, right? This is purchasing or investing in equipment. Now, taking the example of that potato chip manufacturer, I'm going to need equipment, right? I'm going to need fryers to be able to fry my potato chips in to be able to make my product. In fact, I'm probably going to need multiple fryers. So let's do this. Let's chart on the y-axis value and on the x-axis years. Now at year 0, let's say I'm going to buy one fryer and that fryer is worth $100. I expect to use this fryer as a business for 10 years. At the end of 10 years, right, I've used this fryer all the way down until it's like weird thin and it's no value or no use to anyone. It is going to be worth $0. So from year 0 to year 10, it was originally worth $100. It's going to depreciate in value to $0. And what does this depreciation look like? In 99% of accounting instances, it's going to be something called straight line depreciation. And it is as simple as it sounds, right? So if I'm depreciating over the course of 10 years, $100, I'm depreciating $10 a year, such that at end of year 1, it's going to be worth $90. And at the end of year 2, it's going to be worth $80. And this continues all the way till you get to year 9, and it's only worth $10 then. So this decrease in the value of your CapEx or your equipment, that is your depreciation. Cool. So let's bring it back over to the income statement. Where does depreciation and CapEx show up on the income statement? So capital expenditures, it does not show up on the income statement. The capital expenditures is going to show up on our statement of cash flows in the section called cash flows from investing. Now, if we're not including capital expenditures, I mean, it was money that we spent, right? Like we have to capture this somehow. And so instead we're going to include depreciation on the income statement. And that depreciation is going to go into OpEx. Now, the reason capital expenditures isn't on the income statement is that capital expenditures is lumpy, right? If I'm starting this business and making a bunch of potato chips, I'm buying lots of fryers, I'm buying packaging machines, I have other machinery I need to buy, and I'm making all that investment up front, and it's really going to be serving me for the next 10 years. And the thing is, we want our income statement to be useful for us, namely in that we want to be able to compare it year over year over year as a reliable measure. And if we included CapEx in the income statement, in that year 1 or year 0, it's going to look like we are massively underprofitable, like bleeding money. And then in the future years, when we don't have this CapEx included on the income statement, it would look as if we were way more profitable than we should be. So instead, we're going to take that capital expenditure and spread out that expense over time using depreciation. So we said that we had an increase of $10 in depreciation. If my expenses are higher, then my operating income is going to be lower. So it's down by $10. We're not talking about debt today, so we have no change in our interest expense. So then that means our EBT, or taxable income, is going to be down by $10 as well. Now, because my taxable income is less, that means I'm going to be paying less in taxes. So let's assume a tax rate of 40%. That means I'm going to be paying $4 less in taxes. Now, this is a little counterintuitive, so I'm going to show a different example in this corner here. Right, we'll call it taxable income. Let's take a reverse example, right? Let's say I had more taxable income, right? If I started at 100 in EBT and then went up to 110 in taxable income, right? If a tax rate is 40%, then, it's obvious that I'll be paying $4 more in taxes. And so the reverse is true. And it's not always intuitive, but if I have $10 less in taxable income, then I will be paying $4 less in taxes. Back to our income statement. We're paying $4 less in taxes. So I have a $10 decrease in taxable income minus my decrease in taxes means I'm going to add it. So my net income is only going to be down by $6. And this will take us over to the statement of cash flows. Now there's 3 sections in the statement of cash flows. The first is your cash flows from operations. I'm going to abbreviate with CF. The next is your cash flows from investing. Third is your cash flows from financing. And then lastly, you're going to take all of this together and basically sum up the changes in your cash flow from operations, the changes in your cash flows from investing, and the changes from your cash flows from financing. And that will get you to your change in cash. And that's what the statement of cash flows is here to tell us. What is the cash that's going into this business? What is the cash that is going out of this business? What is my change in cash? Because cash is king. Let's start with cash flows from investing first, and then go to cash flows from financing because they're relatively simple before we dig into cash flow from operations. That's where depreciation is going to come in. So cash flows from investing. I alluded to this earlier. We talked about investing in equipment, our capital expenditures. That is going to show up here as an outflow of cash, as our CapEx. Now, what else is in this category? The reverse is true. If I sell some equipment, then the sale of an asset could be a positive figure in here that we receive cash. Other things, say we were doing mergers and acquisitions. If I bought a business, that would be a cash outflow here. If I sold a division of a business, that would be a cash inflow. Anyways, this will sum up and you'll get to your cash flow from investing. Now, cash flow from financing. When you hear the word financing in business and when it's used as a verb, I want you to think raising money. How are you financing that? How are you raising money for it to pay for that? Different ways that you could raise money. First one, you could borrow money, and that is debt, and that would be a cash inflow into the business. You could also raise money through equity and selling ownership in your business. Maybe you do that through an IPO. That money would come in here through cash flows of financing. And the only other main category in here is going to be dividends. Dividends are when you, as a business, have excess cash on your balance sheet and you decide to distribute that cash to the owners of the business. That altogether will get you to your change in cash flows from financing. Now, let's talk about cash flows from operations. The cash flows from operations has 3 main components. The first is your net income. And then we are going to add back our non-cash expenses. The third category, we're going to make adjustments for changes in current assets and liabilities. That taken together gets us to our change in cash flow from operations. Okay, let's talk about each of these. Net income, that is just the same number that shows up in your income statement here, right? Just goes right on over to the cash flow statement. Non-cash expenses. Depreciation is a non-cash expense. Here's what I mean. That person who sold me that fryer didn't hand me that fryer until I handed them $100, right? That was my cash outflow. But let's say we're 5 years down the road. I'm still going to be incurring depreciation expense every single year from year 1 through year 10. And say in year 5, that appears on my income statement as OpEx. That's the thing. I incurred this depreciation as an expense because we chose to spread this expense out over time. But in that year 5, I didn't pay any money. I didn't give any money to anybody else to pay for this depreciation, right? This depreciation just happened. I paid for that up front when I made the CapEx, and that shows up in my cash flows from investing. So depreciation is a non-cash expense that we're going to have to add back to get to an accurate cash figure. Lastly, just really quickly, explaining what this third category is: changes in current assets and liabilities. Assets, things that you own. Liabilities, things that you owe. Current just means within the scope of 1 year. I expect to use an asset or pay a liability in 1 year. We'll just talk through really quick examples. Let's say I have a current asset like inventory. If I have $50 of inventory at the beginning of the year, and I have $150 of inventory at the end of the year, that means I had to put money into making or getting new inventory, right? If I built up inventory, I had to spend money to do so. So that means an increase in inventory is going to be a decrease in cash. Now, what about a current liability? Let's take the accounts payable. Accounts payable is basically a fancy way to say bills that you owe. So let's say at the beginning of the year, I had $250 in bills that I owe, accounts payable. At the end of the year, I have $150 in bills that I owe, accounts payable. That means I paid $100 in bills, and that is a reduction to my cash. Now, we can finally talk about how $10 of depreciation increase affects the statement of cash flows. Net income, we said, was down by $6 from the income statement. Depreciation is a non-cash expense, so we have to add that back. There's no change in current assets or liabilities, so my change in cash flow from operations is overall going to be -6 plus 10, up by $4. Now, if that $4 figure sounds familiar, it should be, because we saved $4 in taxes. No changes in the cash flows from financing, no changes in the cash flows from investing. Sorry, I mixed that up in order. And so overall, our cash is going to be up by $4. Great. Now we can finally wrap up on the balance sheet. The golden rule with your balance sheet is that it balances. And the formula is your assets is equal to your liabilities plus your shareholders' equity. Okay, let's talk about each of these categories. Assets, things that you own, things that are useful. Cash is a good asset. We invested in equipment, right? That's going to go into something called PP&E, which stands for plant, property, and equipment. And then we also talked about a current asset such as inventory. Next, for liabilities, things that you owe. You can owe debt. And we also talked about accounts payable or bills. Last category is shareholders' equity. Shareholders' equity is a bit more of a confusing category. It is mostly a plug to make the accounting math work. And there's really only two main categories here. The first, equity means ownership. So when you issue common stock or preferred stock, we're going to account for that transaction here. But the main category people are going to look at is something called retained earnings. Now, retained earnings is basically the running balance of your net income 1 year after the next year after the next year, right? I'm going to call that accumulated changes in net income. So if my retained earnings balance was $250 at the beginning of the year, and I made a profit in net income of $500 through the year, at the end of the year, my retained earnings account is going to be $750. So how does $10 increase in depreciation affect the balance sheet? Starting with cash. We know from our statement of cash flows that cash is going to be up by $4. We had depreciation in our plant, property, and equipment, so this is going to be down by $10. Now, overall, on the asset side of the balance sheet, plus 4 minus 10, we are down $6. Now, what about liabilities plus shareholders' equity? No changes on the liability side. And in shareholders' equity, we saw from our income statement that our net income was down by $6. And so therefore, our retained earnings and our shareholders' equity is down by $6 as well. And would you look at that? Our balance sheet balances. Okay, so let's recap everything we learned today. Depreciation is the reduction in the value of an asset, specifically of a capital expenditure over time. And on the income statement, if there's a $10 increase in depreciation, it's going to show up as an operating expense, and it's going to lower our taxable income by $10. And if we have a tax rate of 40%, we're going to pay $4 less in taxes, and our net income is only going to be down by $6. Now, this net income takes us over to the statement of cash flows, specifically as the first line item in the cash flows from operations. It is down by $6, but because depreciation is a non-cash expense, we have to add that back to get us to a cash flow from operations and cash figure that is up by $4. Now, this brings us over to the balance sheet, where assets equals liabilities plus shareholders' equity. We just said that cash is up by $4, but PP&E is going to be down by $10 because of the depreciation. So overall, on the asset side, we're down by $6. In shareholders' equity, our net income is down by $6 from the income statement, and so retained earnings is going to be down by $6 as well. And then our balance sheet balances. This channel exists in large part because I want to help you land your dream job in business and finance. For me, it's an impact investing where I get to make money and do good for the world, right? It's about the 3 Ps: people, planet, and profit. Now, if this resonates with you, you might enjoy checking out some of my other videos covering private equity and climate change and so much more. Lastly, if you learned something in today's video, remember to hit the subscribe button, and I will see you in the next one.